Matthew Johnson is with us, president owner Johnson Wealth and Income Management. Great to see you. Thank you so much for being here. Your thoughts on the market action that we've been seeing? It looks like a down week, but we still could be clocking in 2 months in a row for the first time consecutive gains. Your thoughts on where we stand at this point?
Well, thank you for having me, Nicole. It's good to be back on. You know, I would like to think that this is going to be something that's long lasting, but I'm very cautiously optimistic. This may be a bit of a rally that we only get to rent. We really don't get to own it. And the reason I say that is we know that the Federal Reserve still has quite a bit more work to do. You know, inflation by and large is still sitting relatively too high for most of their liking. And so at 7.7%, target goal being 2, we know that they're going to have to continue to do, more increases. I believe that they may end up reducing the amount that they do the increases by, but I think that they're going to be very consistent to stay on a very systematic regimen of raising these interest rates. So we have to be, I think, really, really happy with the fact that we're starting to see the inflation abate just a little bit, but we've got to be very, very careful to think that this is the bottom, because honestly, I don't think that it is.
Right, understood at this point now. So you're expecting the Fed to continue to raise higher for longer. The markets have been reacting to the move in yields, right? So we've seen right now the 10-year is at 3.78. Where do you expect yields to go, and where do you expect the markets to go?
Well, I think as we continue to see what the Federal Reserve says by the end of the year, I expect that they're going to have another rate increase in December. Again, I think it's realistic to think that they're going to decrease it from 75 basis points down to 50 basis points. But I have a feeling that we're going to have a bit of a reality set back into the markets, and we're going to see that the bond yields go back up because they're going to see the Fed's continuing to take that very hawkish approach and increase the interest rates to continue to keep a very close watch on that inflation and keep it going in the direction that they want it to go. So we have to set our expectations to know that we've seen this story before, and we know that they're going to make absolutely certain that they get this right. They want a soft landing. I'm convinced of that. And so far, it seems as though they're doing a pretty good job of being very clear and telegraphing their message of what their intentions are. But I think it's way too premature to be thinking about, okay, they're going to be reversing interest rates, because honestly, I don't think that they can do that financially just yet.
Right, understood. So where do you see, based on that, where do you see the opportunities? If you think a soft landing really is possible, that's what they're going for, right? How would you tell investors to get into the market, or dollar cost average in, or what should they get, whether it's equities or fixed income, or what would you say? Where are the opportunities?
Well, quite honestly, I think that now it's becoming even more important that we're taking and paying attention to the fundamentals. There's a lot of companies that have been experiencing very strong earnings, which is great, but now they're starting to see those earnings decrease. And I think that we're going to see that companies that 6 months ago were still doing pretty strong, now they're starting to bleed some profits. And so we want to be paying attention to own companies that aren't losing a lot of money. We want to be paying attention to value plays. And you know me already, I love to have companies that are paying dividends, because I can spend the dividend, or I can reinvest the dividend back into more opportunities as time goes by. But again, even though we've seen just this little uptick, we want to be paying attention to the opportunities that exist outside of mainstream conventional common stock investing. For a lot of my older clients who just don't have the tolerance to be seeing a lot of volatility in their portfolio, and they're to this age where they need income, we can look outside of conventional common stock and mutual funds, and we can be looking at things like preferred stock. We can look at individual bonds that are paying a good 5% yield right now. Preferreds are yielding somewhere in the vicinity of about 6%. And what I think is super interesting is if we look at things like business development companies, as a sector, they've benefited from this increase in interest rates, and good quality BDCs exist out there that are paying 8.5%, 9% in dividends. And man, some of us would kill just to get that as a growth on our common stock. So we can't take these things and just push them to the side, because I think that they're too well priced right now to ignore, really.
Right, and you know, you did say since January we witnessed 7 market rallies, and at this point now I start to think about the consumer and how they are feeling great and then not feeling great, right? And that's sort of, they're up and down with the market. And there's no doubt that many people have lost wealth because the market has been down, but they are facing inflation, so they pay more of what they earn. And so now, how do you think the consumer is going to behave going forward? You know, we have the holiday season, because consumer spending is obviously the big portion there of GDP.
Well, it really is, and I think that it's going to be even more painful for a lot of the corporations, because if they hired too many people early on, they're going to have to figure out, okay, do we sink or do we swim? And I know in my area right here in the middle of the United States, I'm seeing more and more bigger corporations that are just having to let people go. They're anticipating, with winter coming along and the higher expenses that they've been experiencing and the slower earnings. And I think overall, this is going to be a very slow, painful, death by 1,000 paper cuts kind of a feel. I do anticipate we're going to have relatively strong earnings still towards the end of the year, especially for Christmas and holiday purchases. But after the first of the year, I think we're going to see a tremendous amount of people being laid off. We know that the Federal Reserve has already come out and said that unemployment is still too low. They've got to increase that. And for my own clients, I want to tenor the optimism. I want to be optimistic that we're headed in a good direction, and I think we are, but it's still going to take some more time. So we have to be really super careful of these rallies that we see, because we know that the feds are going to continue to raise interest rates in the future, and we all know what the side effect of that is going to be to earnings and to stock profits and things of that nature. So we have to take into account a little bit of logic and not let those optimistic feelings overrun the fundamentals of actual good investing.
Right. Matthew Johnson, wonderful to see you. Thank you so much. Matthew Johnson, Wealth and Income Management. Thank you.